Good morning, everybody. Jonathan, how are you today? You okay?
I'm very well, Lee. Happy Friday, my friend.
Happy Friday. It's been one of them weeks, isn't it? It's been one of them weeks. It's been very busy. Um, Kids are now fatiguing. I think we're getting closer to another half term. So kids start fatiguing a little bit. Um, I like this time of year, though. I like Halloween. I like bonfire night. And then it's the great build up to Christmas, isn't it? Let's be honest. That'll be here before we know it.
Absolutely. Yeah, looking forward to Halloween. I think my children have got me roped into wearing a massive banana suit and they're dressing up as minions. So, yeah, looking forward to
Nice.
that.
Love that. We do have a fancy dress that we are going to, or a Halloween party. I have no idea what I'm going as yet, or what the plans are. But it's some people go all out, don't they? I feel like every year Halloween gets bigger and bigger. We're kind of following the American tradition on this with Halloween
Yes.
now, but people do go all out with the makeup and the really graphic, horrifying face makeup these days. So
Yeah,
yes,
absolutely.
it's
All good
always a
fun.
good time of year. Good morning, everybody. Thank you again for joining us. We do plan for the webinar to run for the full hour today. So as always, make most of your time with us. If you've got any questions that you'd like to ask myself, or most definitely the expert in the room, Jonathan, please do take the time to ask some questions. We like to keep the floor open. So there's two ways that you can talk to us. You've got the chat function that everybody has access to, that everybody can see, and then you've got the Q&A part where you can keep things a little more anonymous should you wish to. We do have two polls to run today, so if you would like to, and if you can participate in that, it's always nice to hear the audience's thoughts on particular things. I was talking to Jonathan about this before everybody joined, that feedback is so important to us. It's the only way we can improve. Listening to other people's feedback means that we can develop what we present and what we bring to you guys every Friday. So at the end of the webinar, when you exit the webinar and hit leave, there will be a little feedback form that pops up. Please do take 2 minutes to let us know what your thoughts were on the presenter, be kind, the content being delivered, was it relevant, was it not relevant? There'll also be an opportunity for you to get involved with definitely Jonathan and BareRock and us at the club as well. So please do take 2 seconds to complete any feedback form at the end. That would be amazing. Ask questions throughout, or I'm sure we'll have 5-10 minutes towards the end for a bit of Q&A as well, which would be great. I'll kick things off as I always do. Just want to touch briefly on the membership experience for business owners. And this thing grows arms and legs every single week. We've recently launched a bit of a experience the club, which has sold out within a week. 25 business owners that are coming on a journey with us over the next 6 weeks to experience what the club is all about. We're looking at running another cohort in January, so keep your eyes peeled for that. But basically, everything we do at the club is really centered around structure, guidance, clarity, and accountability to make anything and everything in your businesses possible. We always start with a real in-depth, high-level 3-year business plan. What are the goals over the next 3 years? We like to break that down into a 12-month roadmap. What are we going to do over the next 12 months? And then again, even smaller into 90-day sprints. What are we looking to achieve every single 90 days? What are we doing that's really making that needle move? If it's not, what do we do? You could be looking at growing your business. You could be looking at the operational aspect of your business. You could be looking at tech, people, culture, whatever it is. The club have a really good place for you in your business. So please do reach out to us if you want to talk to us about your plans coming into, believe it or not, 2026. So that's really for the business owners. We wanted to create a community that was available to absolutely everybody. So some of you may have come from our WhatsApp groups that 9 times out of 10 are absolutely popping. There's always good questions and good chat going on in those WhatsApp groups. One thing I do recommend is that you do mute them. Otherwise, they'll be going off all day, all night. So do mute the groups if you do want to attend, but do pop in and ask any questions that you do have, because you will get instant responses from other professionals. So we break these down into separate categories as well. So you're not just amongst anybody and everybody. There's about 1,300 people in our community now. We've got business owner WhatsApp groups. We've got financial planner WhatsApp groups. We've got ops managers. We've got power planners. So depending on what job role you play within your business, we've got a real specialized group just for that person within your business as well. Our webinars, Jonathan, are expert-led, as always, highly practical and CPD accredited. So at the end of the day, you'll get an email with a link to complete to get your CPD certificate. We do have some face-to-face events that we run throughout the year as we are coming towards the end of the year. We have one more left, and I will tell you about that, I believe, on the next slide. Podcast is great. You can listen to that on the go, Spotify, Apple Music, or wherever you listen to your podcast, but listen to the journeys of other business owners, the highs, the lows, the goods, and the greats. So please do listen to some of our podcasts. I think we're about 60 episodes deep now, so it's a really good podcast playlist that you can listen to. And as always, our CEO roundtables are very strategic, high-level discussions for business owners. So there's a bit of a way that everybody can get involved with us and everybody else at the club. As mentioned, our last event of the year, and what a place to end it. We're going to Birmingham on Friday, the 28th of November. They are exclusively for business owners and for standalone self-employed advisors. An individual that could be wearing multiple caps within their business at one time. We've done Leeds, we've done London, we've done a few different areas around the UK, and we're going to finish the year off in Birmingham. So Birmingham, do not let us down. So that's the end of November. To give you a bit of an insight as to what the day looks like, it's absolutely stacked. We're kicking things off with a real interactive personal motivators session, which is really, really good. So really understanding your why. We then look at strategies to win and retain clients across multiple generations. We talk about the great wealth transfer that's on the horizon. This is a really good interactive session about how we can start engaging and retaining different generations. And then we finish off with building a client referral scheme that actually works. So everything that we do at our events is collaborative and interactive. So sitting and listening and taking notes is not possible. You will be involved and meeting other business owners that are on a similar journey to yourself. 5 hours of CPD for the day. And as always, it is completely free for you to attend. At the end, on the feedback form, there will be a question that says, do you want to come to our face-to-face event? If you can get to Birmingham, or if you're in Birmingham and you want to come along, please do hit yes, and we'll send you the details. We've got 2 awesome webinars lined up. One in October, I believe it's next Thursday at 4 p.m. So this is with the Money Coaching Institute. This is really about understanding the dynamics of couples and money. So we're going to explore how really different behaviors and different beliefs can shape relationships and financial decisions, and how planners can really use that insight to help clients have a healthier, more open money conversation, if you like. And then coming into November, on the 7th of November, we're with Tatton Investment Management, and this is all about succession planning. So it's maximizing the value of your business. And it's really about how other sort of platforms and propositions can really add value when it comes to buying, selling, or exiting. So it's about preparing your business for succession planning. So we've got 2 excellent webinars coming up. And as always, just register as you have done so for today's webinar. A quick shout out to all of the collaborators. We love these guys. They help all of us. They help all of our club members. They add value. We couldn't do what we do without our collaborators. So a big shout out to everybody that's now a part of the club and helping all of our club members on their journey as well. So thank you again for collaborating with us. So today, Jonathan, I am joined by your great self, 30 years in the industry. All right, so you're the guy that we need to talk to when it comes to our PI insurance. What I love about BareRock is really reshaping how firms think about PI, using data, using technology to really deliver smarter, more client-focused solutions. It's a real passion you've got for innovation within the PI arena, if you like, which is nice. I suppose it's always been seen as something that's quite old school, not changed much over the years, but I think you're shaking that up quite a bit at the moment. So that's really nice. And I'm sure you're going to tell us a little bit about that throughout today. But before we get started, here's a quick snapshot of what the attendees told us ahead of today's session. So we do have a bit of a mix of firms in the room. So from people that are directly authorized to AR firms as well. So really from solo practices to sort of larger multi-advisor firms. Most renewals seem to fall between October and April. So I suppose it depends on the time of the business that they take out PI. Or is there a general rule around that, Jonathan? Do people tend to look at PI at certain times of the year? And I think this is a good thing, right? So over 70% of attendees said that premiums have stayed pretty flat or have only risen slightly. And they've not had to make much adjustment in terms of their operational aspect. So they're not having to jump through hoops to lower sort of PI premiums. So I think that's bringing a lot of confidence to business owners as well, right? Because I think over the last sort of 12, 24 months, you hear a lot of people, especially on social media, having a little bit of their say on the rise on PI. How are you finding the market in general?
Yeah, I'll go into this in the slide deck, Lee, but I think at the moment it's fair comment to say that the environment is perhaps a bit benign, bit of a softer market than what we've been used to. So
Yep.
the feedback that you've got on that slide there, I'm not surprised by. Um, I think the key thing that we'll dive into shortly is the volatility of the PI market. So yes, where we are at this point in time, pretty, as I say, benign, nothing really to write home about. It's not always like that. It is very volatile, sort of a boom bust, turbulent market.
Yeah.
So yeah, we'll be unpacking that shortly.
Let's do it. The floor is yours. I will stop sharing my screen. You can take over. And I'm looking
Okay,
forward to this one.
okay, Jim, let's do this. Thank you.
And as always, if anyone's got any questions, please do just fire them over, and we'll get them answered for you. That'd be great.
Is that showing for you, Lee?
It is indeed.
Great. Well, thanks, Lee, and thank you everyone for joining us today. Making PI sexy, right? So you might be a bold statement. So you
Not
might be
something you thought
wondering
you'd hear
why.
in the same sentence, right?
Yeah, it's a weird combination of words, I accept, but it's actually taken from client feedback that we received shortly after that we launched last year. At the time, it was a compliment that made us smile. We sort of thought it was great, but I think in hindsight, Lee, looking back, we realised it was an acknowledgement that someone actually felt listened to and someone who understood that great advisors shouldn't be paying for the mistakes of the few bad apples. Okay,
Yeah.
so if people can make TikTok dances about mortgages and make them go viral, I think we have a good stab at making PI insurance at least, shall we say, mildly attractive.
So, did you just give us a bit of an exclusive there, Jonathan? Are we expecting to see you on TikTok anytime soon, doing a little dance around PI? Because I'm all for it, by the way.
Well, I mentioned the banana suit earlier, so let's watch this space.
Brilliant.
Okay, right. So I think the key thing for today, I appreciate that PI is a bit of a dry subject, but I'd like the audience today to maybe go away and think of PI less as a necessary evil and more of an essential business ally. So a bit about me. Lee, you gave me a great introduction. Thank you. I'm very flattered. Jonathan Newell, CEO and co-founder of BareRock. I've spent almost 3 decades in this space. And I think the thing that's always fascinated me is how do we take something as important as PI, which quite literally protects an advice firm's balance sheet, the livelihoods of the people that work within that advice firm, but most importantly, PI underpins client trust. So how do we make that work better for firms who are doing things right? And ultimately, that's what drove us to create BareRock. We're not just another sort of PI provider. We're fundamentally changing how PI works, bringing together proper underwriting rigor with genuine innovation. So I just want to take you on that journey throughout today. So here's what we will be covering in the session this morning. Um, we're going to be demystifying PI, so breaking down some common misconceptions, the evolution of the PI landscape, sort of how we got here. I touched upon a few moments ago about the boom bust cycle, so we'll be diving into that and what the impact of that has been. I'll be explaining why disruption was so desperately needed and how we're transforming PI from a transactional product into a value service driven partnership. And finally, I'll be explaining why risk-based premium structures benefit well-run firms and reward quality. Okay, so diving into the misconceptions. First things first, the retroactive date. Okay, so think of the retroactive date in your PI policy as something like a bit of a time machine. Okay, so here's the thing that sort of catches many people off guard. Okay, so PI operates on what is called a claims made basis. Okay, so what that means is it's the policy in force at the time when someone makes a complaint. It's not the policy that was in force when you gave the advice that led to the complaint. So if we look at the timeline on the screen, let's say you gave advice back in, say, November 2020, a client complains now, it's your policy that's in force today that responds to that complaint. But here's the kicker. The current policy must have a retroactive date that reaches back far enough to capture when that advice was originally provided. So in this example, if your retroactive date is set as April 2015 and your advice was in 2020, you're covered. The retroactive date reaches back and captures the date the advice was delivered. So why does this matter? Well, if you ever have a gap in cover or your retroactive date gets moved forward, you could lose coverage for advice that you've given years previously. Even if you had insurance at the time when the complaint came in, if there's no retroactive date which stretches back to the point the advice was given, you could be very well exposed to that claim without falling back onto a PI policy. We often get asked, Lee, what date should we set the retroactive date within the PI policy? So that's quite a common question. So assuming the firm is directly authorized and the firm doesn't have the liability for any predecessors in business, then it's sensible to set the retroactive date the same date the firm became directly authorized. So they align. Your DA date aligns with your retroactive date in your policy. If you were previously, I know you mentioned there's some appointed reps on the call today. So if you were previously appointed rep or you're considering going directly authorized, your retroactive date should still typically be set at the date you become directly authorized. And that is because, in all instances, I hasten to add, it's because the principal firm, when you're an AR, should be covering any claims that spin out of the time that you acted under their authorization. Okay, but please do check AR agreements. Network AR agreements vary, so it's important to interrogate some of the sort of the finer detail on that.
The retroactive date, is this something that you have to negotiate with a provider then to stipulate when you want the cover, or is this something that's standard these days? Is that when was you authorized? Let's have it from this date, or is this something that you've got to educate people on?
It's not a negotiating point in when you come to arrange your PI policy. So I wouldn't worry about that. It's more just to make sure that you pick the right date.
Okay.
Because the insurance provider will rely on the information that you tell them.
Right.
So if you pick the wrong date, so say for example, use the one on the example on screen. If you set the retroactive date here as say January 2021, a complaint arises today connected to advice given in November 2020, you won't be covered.
Right. Yeah.
Okay. Appreciate it's a bit tricky, a bit of a tricky one to explain, but I hope that sort of casts a better understanding on that one.
Yeah, no, that sounds good. Straightforward. So date of authorization, that's where you want the cover to start from, regardless, right?
Absolutely. So Key takeaways here: PI is a claims made policy. It's a policy in force when you receive the complaint that responds, but the policy also needs to accommodate a retroactive date that reaches back to the point when you gave the advice.
Yeah.
Great. Okay, so another area that catches people out, and this is when exactly do you need to notify your PI insurer of an issue? On the screen, you can see two thresholds. On the left, we have the likely threshold, and this is the higher bar. So under this threshold, you need to notify when an issue has a greater than a 50% probability of giving rise to a complaint or loss. So it's got to be more probable than not for that trigger to be satisfied. On the right-hand side, we've got what we refer to as the may threshold, and that's a way lower bar. Okay, so literally you've got to notify your insurer even when there's a slightest possibility, and we're talking as low as 1%, that something could give rise to a claim. Okay, now, here's the thing: different PI policies use different wordings. It's not standardized across the market. Different insurers use different terminology. And this isn't semantics. The difference between the likely and may is enormous.
Yeah.
So if your policy says likely, um, and you've got a situation that feels uncomfortable, but it isn't yet quite a 50% probability, you might think, "I'll wait and see." And that's absolutely fine if it never develops into a claim. But if your policy says may, even that vague discomfort, that slight possibility, you should be notifying your PI insurer. And the
What
problem
happens
here
if you
is,
don't?
hmm, oh, okay. So, yeah, that's a really good point. So the may threshold is way more subjective. Okay, so what I may consider to be a low possibility, you, Lee, you might dismiss it entirely, think it's
Yeah.
completely irrelevant. So there's a load of subjectivity around that may terminology. And it's that subjectivity which can lead to a misunderstanding, and that can lead to coverage disputes. So
Okay.
you may think it's not an issue, a issue develops into a complaint, the insurer looks at that complaint and realizes that there was a point in time where, well, you should have notified it a few months ago, matey, when you
Mm.
could have been an issue. It's that disparity in the understanding and
Mm.
the interpretation of the language. So I think the overriding advice from me is that if you're ever in doubt whether you should notify it, it's always better to over notify. Because if you don't notify, and it later develops into a claim or a complaint, you could find yourself without cover.
Do you think that's people's interpretation of insurance providers as a whole? As in, if I, the more I notify, the more my premiums might go up. Is that kind
I,
of
yeah,
the
I
stigma
think
that
that
it has?
yes, I think there is that stigma, and people don't notify for fear of notifying their PI insurer will immediately knee jerk and have sort of a big impact when they come to renew their policy. I
Yeah.
mean, if you're with a credible insurer, it shouldn't be the case.
No.
Okay, so we are in the risk transfer business. This is
Mm.
what we do. We fully expect. I mean, financial markets are volatile. We are living in a much more sort of complaint-driven society. We've got claims management companies whipping up claims. It's very easy for consumers to make a complaint through FOS. So we are very well aware and accustomed to firms receiving complaints.
Mm.
And that's absolutely fine. You should absolutely notify them. I would far rather a firm be overly cautious and notify. It means that we understand where the firm is at. It also means that we can deploy support really early on in a complaint before it develops into something that it shouldn't. So
Yeah.
yes, there is a stigma. I would encourage firms to set that aside and just have sort of trust in your provider and just really make sure that you protect your position and inform them of every situation.
Yeah. And that's where people see PI as a cost. And not as that strategic alignment, isn't it? I know we talk about it a lot, and not just seeing it as I've got to have it because it's the FCA say so, or whatever. I think it's more looking at it as strategic partner about how we can build bridges and make things more secure for your clients and for you as a business owner as well.
Yeah, absolutely. And as I said earlier, I mean, PI covers, as I say, your balance sheet, your livelihood, but the key thing is it underpins the trust with your client. So when things go wrong, you want your PI policy to step up
Yeah.
and correct that error. So that's really integral. But I'll move on to that briefly. So quite often, leading on from that last slide, we often get asked, so what do we actually need to notify? Okay, so again, it's a bit subjective.
Mm.
So there's two things that you need to notify. One is a complaint, and that is pretty obvious what a
Yeah.
complaint is. A client phones you, emails, or you receive a letter that expresses dissatisfaction. Very, very obvious. When that happens, you activate your complaint handling procedures in accordance with the FCA's DISP rules. And I hope everyone knows that when that happens, you also need to notify your PI provider. What is equally important, and this is the thing going back to your point, Lee, which is overlooked, is the requirement to notify a circumstance. And circumstances are situations that could give rise to a complaint. And these are trickier to identify because they often involve scenarios where you, as the advisor, has spotted an issue before the client has even become aware there might be a problem.
Right.
Okay, so I'll give you an example. Imagine you discover during a peer review that a client's fund switch instruction wasn't actioned when requested. The client is unaware of that error. Okay, so maybe the fund that the money sat in cash for 6 months, it should have been invested. Over that time, there's been some growth, and because of the non-investment, there's been sort of some client detriment. So, as the advisor, you would obviously need to gather information from the provider
Mm.
to assess the financial detriments, but you also need to notify that to your PI insurer, even though you haven't received a complaint at that point. So that's a really good example of a circumstance.
What would the benefits of that be, Jonathan?
So you've got to align. So you need to imagine that you and your PI insurer are kind of you're on the same team, okay? Um, and we need to make sure that when you correct an error, that you correct it in a way which protects the firm's best interests. So there's when closing down a complaint or resolving a complaint, there's certain terminology in the letters that you issue and how you communicate that to the client to shut that complaint down properly. And if you don't do that, it could just leave the firm open and exposed to further complaints later down the line. So it's more to do with the sort of the technicalities of how to resolve a complaint. You also can't admit liability without involving your PI insurer, and that's a strict no-no. It's the same with every insurance, right? Have a ding in your car, you don't admit the liability. You've got to talk to your insurance company first. So you can't commit the insurer to a liability without getting them to pre-approve it first.
Yeah. Yeah.
Okay. Right. So, and moving on from like this segues quite nicely into the 3 day rule. And the 3 day rule is a little known part of DISP. For those who love studying DISP, it's DISP 1.5, and as I say, it's also known as the 3 day rule. And what this does is it essentially empowers firms to resolve a complaint within 3 business days. Okay, so if you resolve it within 3 business days, you avoid triggering your complaint handling process, FOS referral rights, and all that malarkey. And it also means that you don't have to include it on your complaints return when you report back to the regulator. But the problem here is that traditional PI policies require you to notify that complaint and await instructions to come back down before you do anything. Okay, so by the time you get the clearance from your insurer, especially if you're going through a broker and you've got 5 day SLAs that are involved, by the time you get the instructions and the go ahead to do something and to resolve that complaint, you've blown past that 3 day opportunity. So the 3 day opportunity has now gone, and you're now forced into handling that issue as a formal complaint and triggering the complaint handling process. Okay, so on the one hand, you've got a really smart, and this is not often I say this, but you've got a really great rule within the FCA DISP rules that allows for quick resolution of the complaint. But that is butting heads and rubbing against your PI policy that says you can't do anything, you're paralysed until you get instructions from us to do anything. So this creates negative friction. So minor issues that should be resolved quickly can really blow up into formal complaints. And for me, and we've heard this time and time again, it really damages advisor-client trust. So nobody wins, essentially. So what we have done, hopefully here we go. So we've worked, when we built BareRock, we identified this as a bit of a problem. So we work with some compliance consultants and legal advisors to create an industry first framework, and have built a clause that empowers our club members to handle complaints within the 3-day window without triggering the PI notification. So we provide template letters and complaint resolution letters directly to our club members so they can handle it proactively without damaging or foregoing any cover. And this is about trusting our club members. We don't need to sort of hover over them at all times. Our advisors that we look after, they understand their clients better than us. So who are we to get involved in that and sort of add some friction? That said, if it's a potentially a big claim that exceeds your self-insured excess, then you still need to notify us and get involved. What we've done here is sort of clear the path for those minor issues and niggles so you can move forward with your client and retain that trust with them.
Because I mean, that's hit the nail on the head, hasn't it? Really, I think the quicker you respond and react to that, it saves any sort of damage to the relationship, doesn't it? If you're going to notify your PI insurer and you've got to wait for feedback and wait for their response, and the client's now going a day, 2 days, 3 days, 4 days, 5 days without hearing anything, and it kind of feels like, not that you don't care because it's out of your hands, you don't know what you can and what you can't do. But this just gives a little bit more ownership on that firm to really take control of the situation, manage the expectations of the client, and save the relationship ultimately, isn't it?
Yeah, it saves the relationship. If anything, it can improve the relationship
Yeah,
because it gives the advisor the space. There's nothing wrong with being vulnerable. Showing vulnerability shows trust. It engenders trust. So there's
yeah,
nothing wrong with that at all.
yeah,
So quite often we want to not only preserve trust, but quite often a complaint situation can improve it if the firm is enabled and
yeah,
empowered to deal with it really quickly and professionally.
yeah, yeah, absolutely.
Okay, um, so let's zoom out a bit. So that's some of the demystifying done. I hope that was helpful. Um, Thank you. So yeah, so technical confusion tick. So let's sort of, as I say, zoom out and look at the bigger picture and how the PI landscape has evolved, or maybe should I say hasn't evolved, and what this means for advice firms. Um, so I personally think the traditional PI market has suffered from three fundamental problems. Okay, there's one size fits all underwriting. What I mean by that, good and bad firms are essentially treated as one homogenous risk pool. Everyone's treated the same, and the premiums are only really driven and modified by the firm's turnover and claims experience. So very few modifiers. There's also, for me, secondly, a lack of data insight. I'm sure people here on the call are familiar with uh, fillable PDF forms. I think you'd be surprised how little of that data is actually captured and analysed. So essentially, the traditional market bases their decisions on limited information and gut feel rather than genuine risk assessment and data assessment. And third is the boom bust cycle. We mentioned earlier, and I'll go on to talk about it shortly, that we're in a soft market at the moment. That's fine. That's great. What history tells us time and time again, and we've all lived through it, that when what goes down must come back up. So what we want to do is sort of do away with that boom bust market volatility. So the reality is that the traditional PR market hasn't meaningfully evolved in decades. Certainly in the 30 years I've been in the industry, it's stayed pretty much the same. How it's transacted, the UX and the UI around it all has stayed pretty the same. Same structures, same cycles, and the same frustrations.
Yeah.
Um, so this is the FCA data on PI, and I appreciate, hands up, it only goes up to 2023. That is the last published data that we have. But I think this is probably a good history lesson here. As I say, we're in a soft market. It's benign. The poll results that you had earlier there, Lee, are very positive. That's great. It's not always like that, and this demonstrates the point. We've got here the blue line, where a firm, those are firms between 100k, 500k turnover. They were paying about 1.9% of revenue in 2017. That jumped by 170% to 3.2% in 2023. A big increase as well for the 500k to 10 million turnover firms as well, jumping from 2.7 to 3.13%. That's a 117% increase.
Yeah.
So to try and understand some of this sort of volatility and where it comes from, especially the recent hard market, I'm guilty of like short-term memory, right? Optimism bias, but it wasn't that long ago, Lee, that we had a real difficult PI market, incredibly difficult, to the extent firms had to close because they couldn't source PI.
Really?
So yeah, it was incredibly difficult, and I'm sure for some firms that's kind of imprinted on their memory for a very long time. So the last hard market, we can see it spiking there, sort of 2019 time.
Mm.
This stemmed from Lloyd's of London, so the biggest insurance market in the world, or certainly the most renowned marketplace. Lloyd's of London, they undertook what was called the Decile 10 review. Essentially, that analysed the worst performing lines of insurance within the London insurance market. Bottom line, PI was in the firing line. It was the worst performing line of insurance. Globally, the global premiums underwritten at Lloyd's, I think generated like £500 million of losses over a 6-year term. So Lloyd's, as the quasi-regulator in the sector, jumped into that to shake things up a bit. As a consequence of Lloyd's intervention, 12 insurers, maybe more, withdrew from PI immediately. So that's it, done. Literally, Monday writing PI, Tuesday note, done. Teams of people were made redundant overnight. So there was an instant capacity crunch. Very few insurers were left over. That created
Why is
huge.
that? Is that just because there was just so much payout in premiums opposed to?
Yeah,
Yeah.
yeah. So huge payout in premiums. I love insurance. I love the market. I think there was perhaps too much competition in the market,
Okay.
and this is why I'm a bit reluctant about. Yes, everyone's happy with how their PI is now, but I think we're in that pattern. Things are getting softer. People are writing below what is technically viable, and there's going to be a knee-jerk reaction at some point in the future. But I won't go into that too much now. Insurance companies, just to answer your question a bit more fully. So insurance companies are multidisciplined, so they write various lines of insurance, in reinsurance, so marine cargo, nuclear risks, property in North America. So they got a diverse portfolio, and they typically use other parts of their portfolio to offset poor performing parts.
Yeah.
Which is fine until kind of the regulator comes knocking and say, right. So they would typically use other lines within their portfolio to offset the poor performing lines. They would also rely upon investment returns. I mean, insurers sit on billions of money, £1 billion worth of money. They would rely on investment returns to offset poor underwriting. Okay, which is fine when investment returns are doing really well. The economy is incredibly volatile, so I think Lloyd's wanted to make sure that underwriting discipline was sharpened up. So that was the backdrop on which BareRock was created. Okay, we wanted to fundamentally reimagine PI as something sustainable and that could withstand the market cycles. I think that leads us nicely into the first poll, some of which I think was probably covered
Probably.
earlier.
And,
right, but anyway, let's dive in anyway.
Is this the PI shock?
Yes.
Yes. So please do cast your vote. How many of you have experienced significant PII shock in the past? So we're looking at price, coverage, both, and no. If you were sitting in front of 10, 15, 20 firms, where would you cast your vote, Jonathan, as to what you typically see within the industry?
Um, it obviously it varies on how old the firm is. So firms
Okay.
that have recently become directly authorised or have set up a new company or have exited a network and gone DA probably haven't experienced the hard market that I referred to earlier. They've kind of entered into this the world of PI and everything's all fine. My last three renewals have been really easy and premiums have been coming down. Um, from my 30 years of experience, it is a boom bust market. And certainly for firms who are, I don't know, mature is perhaps the wrong word, but who have been DA for a longer period of time, I would certainly, and as we can see here, I think yes, price and yes to both. Uh, the things that we saw during the last hard market is that not only did the remaining insurers that were left after those who exited, not only did they massively increase premiums, they really started to restrict coverage as well. So putting quite onerous exclusions and putting the risk and the exposure back onto the advice firm.
What would an advice firm typically do in that scenario then? If they've got limitations on coverage, are they pulling out of giving a particular type of advice where they just go, well, okay, we won't do protection or we won't do mortgages, or, do they start to really assess their business?
Yes, well, not only do they have to assess it, I think there's three things. Yes, they have to assess their business. An exclusion on their policy would also trigger an additional capital adequacy payment or
Right.
reserve on their balance sheet to offset
Yeah.
that exclusion. It would also mean that the regulator would expect them to stop giving advice in that area going forward. The obvious one to pick on in recent times is defined benefit
Oh,
transfers.
you went there. You went there. You don't hear it too much anymore, do you? You really, really don't. I think go back 5, 6, 7 years ago, and DB business. But now, when we speak to advisors, they're
Uh,
just not writing it.
do you know what? Do you know what? That is a real. I think that is a real shame, and it upsets me because I think there are consumers out there where, not in all instances by any stretch of the imagination, but I think there are consumers out there
Mm.
where a DB transfer is absolutely the right thing for them, given their
100%.
circumstances. But
Yeah.
because of what happened in the PI market, and because of what the consequences, the regulatory consequences of that, we're in this scenario now where advisors don't want to go near it, which I think is a real shame.
Yeah. Yeah. Definitely.
Shall I, shall I close that poll down?
Yes. Yeah. I've stopped sharing it so the audience can't see it.
That's interesting. Great, let's crack on. So we've seen the problem. Now let's talk about why the market was ripe for some disruption. Um, do animation here just to kind of describe what I've been speaking to a bit earlier. So the traditional approach kind of led to this boom bust market, super volatile, insurers pulling out, jacking up premiums, and then underwriting profit comes, and then sort of premiums come tumbling down. It's that yo-yo effect. So our approach is very much about smoothing that, making sure that we deal with good firms that have the right processes in place. And we are already polls are coming thick and fast. We're diving into the next one. Um, Kind of leads on from our previous one, but has anyone had to make any changes to their business model due to PI constraints? And I know we kind of like touched upon that earlier, and I'll talk to you about my experience briefly. So what we saw during 2018 was major impact. Um, um, Again, not want to repeat what I said earlier, but DB transfers, we had firms that were giving good advice to clients in the right set of circumstances who just had to stop giving DB transfer advice. There were other sort of scenarios back in the day. Endowments was one. Um, Scarps was another one. So it always seems to be like product led.
Mm.
where insurers sort of take a knee-jerk reaction to it, whack on exclusions, and that kind of um, means advice firms have kind of got a hand tied behind their back.
Do you think firms need their hand held in some situations? A bit of support, bit of guidance, what you can and what you can't do moving forward, instead of just outright saying, right, that's a no more, you can't do it.
Oh yeah, so handheld. So we would rather. So if a firm is going to sort of enter into a new advice space, which they haven't done so previously, we would absolutely love to work with them just to understand how they're doing it. John, my co-founder, he's got 30 years regulatory compliance experience, so we can certainly add some value and give you some pointers as to how to deliver the advice. A broad statement: we don't think there's no such any such thing as a bad product. There's only poor advice. So we concentrate on how a firm delivers the advice, not the product.
Right, gotcha. Yep, yep. Yeah, so just no impact for a few people that did participate in that poll.
Yeah. Okay. Right. So how BareRock kind of shake things up a bit. So enough about the problems. Let's start talking about some of the solutions and how we're changing PI from a grudge purchase into a something more of a genuine partnership. So first things first, it starts with a dynamic online form. As I said earlier, all PI forms that we've seen are still PDF based. So we've dragged PI kicking and screaming into the 21st century. There is this thing called the internet. Insurance is certainly commercial insurance, but under market, I think is antiquated. It's catching up. People say that about financial services, Lee, but I think
100%.
insurance is behind the curve when it comes to financial
Really?
services. Yeah, definitely. So we've got an online form, which I'll give you a quick show and tell very shortly. And what that enables us is that we've got empirical data capture, so we can understand your business better. Okay, that's really important. Um, we also within our tool have a collaboration tool, so it's an online tool. The benefit of the old PDFs is at least you could share that amongst your team. Different people could fill in different sections. So we had to make sure we could sort of carry it across that UX and UI into a digital form. So we got that UX and UI built in. And the main beauty of capturing all the data is that we save all that data in year one. Okay, so when you come to renew your policy in the second year, all you've got to do is top that up with what you've done in the last 12 months. Whereas the traditional PI applications, it's just rinse and repeat. You've got to trawl through and just repeat the same information that you've given their provider for the last 5 years, and they keep on
It's a
asking the same
start
questions.
again process, is it, for these people?
Start again process. You get the same PDF that you filled in 12 months ago. You even have to write your name, your address, your email address, all this kind of stuff that already exists.
Okay.
So I think our record in our renewals is that and it's a standout record. We've had a client renew their policy with us in 22 minutes.
22
So
minutes.
22, yeah. Whereas before, it took days for
Yeah.
firms to do it. It took
Yeah.
days. So the little sneak peek. This is how we do it. This is a quick video of our application form, nicely chunked up into three areas: people, process, and your products. That little paper aeroplane there, you can delegate sections to colleagues, get them to fill it all in. You can set up new users on your PI application. The application form cascades and molds to your firm. So if a question isn't relevant, we don't ask you 10 irrelevant follow-on questions. It just skips to the next relevant part of the application form for your firm. So again, the PDF proposal forms, you have to read every blooming question, even if they're not applicable to your
Yeah.
business. We waterfall and the form intelligently builds around the shape of your business.
That's
So
awesome,
one
mate.
of
So
the
you're only answering the questions that are relevant to your business. There's nothing worse than reading a form and clearly say if this is not for you, skip to section 6.4. You're forever going to and from, back and forth, and have I missed a bit? Have I not missed a bit? It's just confusing, isn't it?
Absolutely, mate. Absolutely. So this is how it all stitches together for us. So not only do we deliver a better user experience as well, we connect all that data. So we've got the proposal form data, we've got the policy rating, so we've got our own proprietary policy rating, and the claims information. The API data, again, just to make the application form easier, we connect with the FCA register and Companies House, as well as sanctions checking, just to put in data, just to ease the workload on our firms. We also connect to payment solutions, so integrated APIs to payment solutions at the back end. Traditional PR market, all of these are looked in isolation and they are siloed. So essentially, by bringing it into a digital platform, we can get a full 360 view of what a firm is and how we should rate them properly. And this is what risk-led underwriting actually looks like in practice.
But surely this makes sense. Surely
Yeah.
you'd look at that and go, yeah, absolutely, I understand why you do it, and I understand the benefits of doing it like this, and why is everybody else not doing this? Does that make sense? It's the world we live in.
It's, I know, I know. I mean, this is where we saw the opportunity with BareRock. Okay, so
100%.
everyone just everyone was in a bit of echo chamber
Mm,
and very kind of quill and pen, quill and ink kind of way of looking at things. And we just looked at PI, right? So let's pretend we're in 2020. So when we launched 2024, we're in 2024. PI doesn't exist. Let's build PI from the ground up without looking at anything that's gone before us and just
yeah,
like build it afresh. So how well run the firms can benefit from risk rated solutions. On the screen here, you've got the traditional legacy how model, the legacy model, how traditional PI insurers look at your risk. And as said earlier, they tend to treat all firms as one homogenous risk pool, good, bad, or indifferent. They're pretty much all treated the same. And the influence arrow there, you can see that the traditional market pay way more attention and influence to the market base rate. And then you've got other factors like the turnover of your business. And sadly, at the bottom, the individual firm's qualities don't get much of a look in. We've just essentially just flipped that on its head. We think the firm's quality should absolutely be the most dominant factor in how a firm should be rated. Of course, there are the economics which drive cost. Turnover and base rate are still influential, don't get me wrong.
yeah,
But as I say, the driving force that should influence a firm's premium are their own characteristics.
yeah.
And that's what we tease out of that application form. We look at culture, conduct as well as the softer areas of a business, not just product count and product type. And that leads on to how we make this model a bit more concrete. So, like you guys, Lee, we developed our own club as well. We've got the BareRock Club, and the BareRock Club is there to genuinely recognise and reward well-run firms. We have a tiered membership structure. Um, Entry level is club, so those are for the firms who meet our stringent standards. Beyond that, you've got Club 10, and that is what it says on the tin, a 10% discount. And those are for firms that show stronger compliance frameworks, great risk management and quality processes, and those who can clearly demonstrate to us that they invest in doing things right.
Mm.
And our top tier, these are for the exemplary firms. Only about 5% of the firms make this, so it's quite a hard
Really?
tier to get into. Yeah, it's really interesting. But these are for the outstanding firms, those with sophisticated risk management and a proven track record, highly qualified teams. And as you can see, it's what we've set up here is an aspirational membership scheme.
Yeah.
Okay, so we're not just selling a transactional product. Here's your PI. We see you next year. We want to encourage firms to climb up the club tiers to unlock those premium discounts. So when a firm comes on board with BareRock, we would proactively work with them, reach out to them, help them, give them tips, tricks, and guidance as to what they can do internally to help them ascend up the club tiers to unlock those discounts in the future. Most importantly, and what this visual captures is what we're doing. Good companies in good company. That's not our tagline; it is our mantra. So traditional insurers treating everyone the same, everyone is lumped in together, and what that unfortunately leads to is the claims. The claims performance, the complaints performance of a few bad performers impacting everyone else in that risk pool.
Yeah.
So, what we've done by setting the bar really, really high, we insulate our club members from the impact of the bad actors. So we're not, BareRock is not here to insure every firm. We are only here to insure firms who are like-minded with each other, and we're building a quality network, and a club that rewards and recognises that. So a highly selective group.
What is that bar, Jonathan? What is that bar? If somebody was sitting here, and everybody knows what their business is like,
Yeah.
is there a bar that they can look at and go, I'd probably sit on this side and not that side?
Yeah, no, a good question. I can't give our secret sauce away because it just risks people sort of gamifying it a bit. But as I say, our focus is culture, conduct. I'll give you one thing. One bit of takeaway. So the one thing that we look at is third-party file reviews quite closely.
Okay.
So what we would like to see is to make sure firms are testing themselves against what good looks like. And what we sometimes see is firms just internally peer reviewing that, which is okay to an extent, but it's a bit
Yeah.
like marking your own homework.
Yeah.
Okay, so for example, we would look at, do you use a third party compliance consultant? Do they at what level are they engaged? Are you just buying their off the shelf kind of compliance manual, or are they proactively engaged in file audits and reviews? How often are you having reviews? Do you have a back office system? What systems do you use? So it's a bit more of an interrogation, and
Yeah.
all these things build up a risk profile and a point
Yeah.
score.
Yeah. Makes sense. Yeah, makes sense.
Okay. Um, right. So I mean, just a brief recap here. So we today, I think we're sort of heading to the end. So perfect timing, I think.
Perfect timing.
Yeah, so we demystify PI. Hopefully, I've explained to the audience the evolution of the PI landscape, and it sounds like the people on here haven't experienced a hard market, and that's great. Um, I'm pleased that everyone here has seemed to have a pretty good experience with PI.
Yeah.
Be warned, it's not necessarily always like that. Um, here we go, and I'll just flip on to the next slide just before we wrap up. Um, Appreciate people's here. Some of them might be ARs, and those who are DA or renewal may not be due imminently. But if it is, drop us a line. You can scan that QR code, and via that QR code, you can either kick off your application straight away, or alternatively, there's a very short form that you can just fill in, and we can remind you and reach out to you when it's a bit more appropriate.
Nice.
I think
Jonathan, that was great.
set.
Really enjoyed that. And I think the world goes through this cycle of something happens that creates a bit of a shake up in the industry, right? Pretty much like what you said in 2019, PI premiums spiked, and that's where BareRock really sort of come to market and said we need to do things different. And it's very much like the financial planning world. I mean, if you look at financial planning sort of pre-COVID, it was full on suits in the office, Monday to Friday, 9 till 5, paper based. It's a very old school run business, wasn't it? Let's be honest. It's very, very traditional. Most businesses run fairly similar. Fast forward to a post-COVID world, and you barely see somebody in a suit these days. You used to walk around a conference and everybody had a suit on. Now it's few and far between. It's chinos and t-shirts, and it's just you need shake-ups in the world for the innovators to come through, very much like BareRock did, which is great. I think the market needs these shake-ups, but we need people like yourself that bring new ideas and new products to the market to keep people pushing along.
And I think maybe the one differentiator between financial services and insurance is that insurance is inherently risk adverse, right?
Yeah,
So,
yeah,
I mean, generally people don't like change, but believe me, people in insurance like it even less.
yeah,
So,
yeah,
to try and bring along people on our journey, it had its challenges. We had to break down and keep on knocking down like misconceptions and keep
yeah,
on banging this drum. It wasn't easy. it sounds really obvious when we talk about it on this great conversation I've had with you today and the audience. It sounds really obvious, but actually achieving it was just a different ball game.
Yeah, 100%. Yeah, I can imagine. The thing is, people don't like change, but when they're forced to change, better things happen. And that's the real difference. Nobody likes change. Everybody loves routine, and if it's not broken,
Yeah.
why fix it? But the problem is when you're forced to make a change, that's when the good stuff happens. You're out your
Yes.
comfort zone. You're
Yep.
absolutely out your comfort zone. So you look at something from a different perspective. When you look at something from a different perspective, wonderful things can happen. I'm a
Yeah.
firm believer
I
of it.
mean, when we launched Lee, I mean, people looked at us with a bit of skepticism, and we
Yeah, I
weren't
bet.
sure. And it was like, okay, um, this is going to
Yeah,
be a bit of a tough gig to get people with our line of thinking. But now we're kind of like 20 months in since we launched, and it's just landing really well.
good. Mate, really, really pleased for you and everybody at BareRock. If anybody's got any questions, please do fire them away. If not, have a wonderful weekend. We're back next Thursday. We've got a random slot Thursday, 4, I believe it is, 4 till 5, because somebody from the Money Coaching Institute is in America. So that's where they're based. So we're having to adapt to the time difference. So I think they'll have sleep in their eyes at 8 a.m., where it'll be 4 p.m. in the afternoon for us. And then after that, we're back to our usual Friday slot. So if anybody's got any questions, please do fire away. If not, please do complete the feedback form. Have a wonderful weekend, and we will see you all soon. Thank you very much for your time.
Thanks, everyone.